Welcome, traders. In this video, we're going to go over what the classification system means and how we go about reading it. And we want to go over and we want to look at what these patterns are going to be telling us. So the first thing we want to do is I want to bring everybody's attention to one of the settings within the divergence indicator itself. Okay, so the setting that I want to talk about and make everybody aware about is the very first setting where we're going to reconstruct the tape and we're going to look for a minimum filter of 25 contract orders or more. This is something that makes this divergence indicator different because unlike other software out there that only report the size of the fill, we're able to go back in and reconstruct the order and look for orders of 25 or more. Now, here's the issue when we do that. And I thought about this both ways, and I just want to bring it up to the users. What we're doing when we go ahead and reconstruct the tape, and we only look for a minimum order of 25, what we're saying is we're going to ignore all orders that are between 1 and 24 contracts. So the values that we receive in our KP2, KP3, and the KP2 ratios are all only representing orders of 25 or more. Okay, so what I've done is I've gone and created two identical charts, and the bloodhound signals aren't going to be any different because the bloodhound signals aren't being filtered. The only thing that's being filtered is the divergence indicator. So the first thing we see right off is a long trade here where the long trade was giving us a green go signal, and that trade worked out fine. But when we look back on the all contracts, we see that we were picking up a combination of a lot of sellers that were small lot sellers, and that didn't give us any delta between the low put in here and the low put in here. It was only a -7. So instead of having a positive 720, which we saw on the 25 or more, we saw that we had only a -7. And also, as you can obviously see, the accumulation was picked up there to go along with the long trade pattern and the order flow. So kind of a few differences there. Also, as we come up here and we make the top, we see that the ratio was over the setting of 95, thus giving us a black marker up here. Now, what you need to understand, though, is because we're looking at all trades, there probably should be some research to go in to finding what would be a more optimal setting of 95 for the KP2 ratio. So that's a couple of the differences that we can see just right off the bat. Now, the reason that we are filtering for 25 or more is because we're looking for divergences that involve where the large lot traders are at. So as we can see back here at 1119, we had a special divergence trade that worked out fine, and that was picked up on both charts. But that is basically what we're looking for, and the reason that we have this set to 25 or more. We also have at 12 o'clock, we have this special divergence pattern along with a trend trade pattern and order flow that took us into an extremely good trade worth almost 6 points. So that is the argument for both. And if you wanted to see all divergences, you could actually do that. If you wanted to see divergences based on all contracts, what you would basically be doing is you'd be putting another instance of the indicator on the chart, and you would just not be checking the appropriate boxes for the key point data. So if we wanted to put another instance on the chart and only display one of the key points data, what we would do is we would uncheck this box here and we would uncheck this bar for the criteria, and then we could have two instances showing all divergences based on both 25 lots or more and or all contracts. So that's basically how you would go about putting two instances of the same indicator on the chart. Now, as far as the other settings go, I'm looking for a price deviation value of 2 points. And it's very important right here that where it says zigzag plots, that you change this from the light blue color that the programmer had initially put in and change that to black, because what that does is that affects the text color of what we're going to see. So you can see these a whole lot better. It would be a real good suggestion to change that to black. You can also go and change the font and make it a little bigger for those of us who have a hard time seeing the smaller type. And you can do that there and turn it to bold. Now, what is important for the criteria is to be able to see this, we have to check this box right here for the show markers for criteria. Now, I've gone ahead and set the KP2 ratio at 95. I've set the KP3 value at 500 and the KP2 value at 1200. So let's take a quick look at what that means. Okay, so basically what we're looking at is the KP2 is a high to a low or a low to the high, and the KP3 is a high to a high or a low to the low. So in this example here, here's KP3 starting, and this is where it ends. In the low to the low start and the end. And so the KP2 being a high to a low or a low to the high, we're looking at this low to the high right there and the high to this low right here. Now we get the KP2 ratio by dividing whatever number this is by the number of ticks. Now, this is what is really important and what differentiates these numbers from anything else out there, and why this is so important. Everybody always talks about order flow, and order flow is important because, as you can see in these trades, we want to have both a price pattern and we want order flow. But what is equally important, but never has been talked about, is what are the limit orders doing? And if you have a program like Bookmap, and I do, basically what you're going to see is where resting live limit orders are at. And in a very liquid market, that is a good thing to see and understand. And that's why I have the Bookmap program. But one of the things that's never has been talked about, and what I have basically discovered here, is that when we take this KP2 ratio, we can look at the contracts as they're being accumulated. And this is probably the biggest reason why this whole idea is different. And this is the reason at the beginning of the video I presented the idea of not reconstructing the tape. So you can actually see every single contract that was accumulated on limit orders, and not just the contracts based upon a reconstructed tape of 25 or more. There's a real good argument for each, and it really comes down to what you want to see. So this KP2 ratio to me is extremely important, because what it does is it tells me when a market is likely to reverse. And as we can see right down here at 1237, when the low was put in exactly at my strong trend support zone and then reversed higher. That bottom was actually held for approximately the next 40 minutes, 45 minutes, and until it was broken and the market traded even lower. But what was definitely happening is there was an accumulation of contracts there. And then we traded higher into a broken reversal pattern here, and that did signify the end of our short trading patterns. So what is the basic look of what we want to see? Well, the basic look of what we want to see is pretty obvious. We like to see, if we're going long, we'd like to see green here. We would also like to see green preceding it. And we would also like to see green going out of it. And we see that pattern here, and we see that pattern here. Now, as the market transitioned from bullish to bearish, again, we get that same exact pattern here. The really great thing about this pattern here is not only did we transition to bearish, but then we got the special divergence at exactly where we would be looking for it, and that is the intermediate resistance zone right here. And again, so that if you're new to the program, you're not receiving this indication of a short trade throughout the period right here. You actually got it exactly where the apex was, because that is where a new zigzag formed. That's why we want to match the value in deviation points in the zigzag to the deviation points in the divergence indicator. Here's the 2-point setting for the price deviation value there, and here's the 2-point setting for the deviation points in the zigzag. Okay, so that would be the optimal pattern of greens and reds going into this. Now, what is less optimal is what we see happening right here, where we had put in the 169, the KP2 ratio, and we have the black KP2 warning marker. Now, what we are going to be afraid of is that we are going to be afraid that this is an accumulation that is occurring as price fell. And we're going to be worried about this short trend trade here. And we're going to be doubly worried because we didn't get any reaction from our strong trend area. And that is what takes us into this broken reversal pattern. Now, I realize that this video is not about the patterns. What I'm trying to get across to you is that this short trend trade here didn't work. It only got 11 ticks from apex to apex, and that's not successful. So while we didn't lose, we didn't make anything either, and we had to probably pull the trade at around break even when it traded back higher and we saw the order flow and price pattern. So that is what we're going to be worried about if we get into a situation where we see a black marker that's going to precede our trade here. Now, if we come back and look a little bit earlier, what we see is we had distribution occurring back here, and while price did trade about a point higher and stay at that point, we can see the next time up we had a number of 91, and that is in and of itself very close to the number giving us a black number. Now, I had a couple of excellent examples when I was developing this as a strategy idea, and they are listed on the cumulative delta classification strategy page. You get that from the website by coming up here to the trading strategy and then cumulative delta classification strategy. I've just gone and recently updated it, but I wanted to show how this is a very important pattern to look out for, because in each of these trades, This chart is kind of old, so I don't know that I could go back and find this in the history. But what the point was here is that first we had a black classification here, we had red classification, and in this case we had special divergence coming into this trade. So, and then as price fell even further into an exhaustion pattern, we again had a black classification. And then what that took us to is that took us to a losing trend trade here. And you can of course see the results. Then we had exactly the same pattern, 100% exactly the same, where we had black down here, taking us into a red classification, taking us into a second exhaustion pattern, which again was classified black, and that led us into a second losing trend trade. And a little bit further down on the web page, I played this back in market replay, and the KP2, KP3 numbers for each of these trades, they weren't either one of them. There was no warning that there was a significant amount of buying from the low to the high in either one of these trades. A little bit higher up on the page, there's another example of this, exactly the same pattern, where in this example right here with a 153, we were in a strong trend. Again, the strong trend pattern took us into a short exhaustion trade, and at the short exhaustion trade we had a second black classification, and as you can see here, that trend trade lost also. So the idea of using these black classifications as market turning points is an extremely valid idea, and one that should not be overlooked. And when you go and look at this picture also, I'd also note that here at this top, which is in between the two exhaustion trades, we again were putting in a number of 99, which would classify this as a distribution. And then from that distribution, I think we sold off something like 7 points. Now, the last thing we need to talk about is we need to talk about why I placed these yellow markers here. And the yellow markers are indicating that there was some kind of divergence that had been picked up. So as we see here, we have numerous divergences being picked up. Now, the reason that I've gone and put these on the chart is for right now, we're not sure what side these guys are playing for, if they are telling us something bullish or if they are telling us something bearish. So I call this the Joker symbol. So if we look at the trade here where we had the accumulation signal, we see that the markers, both of them for KP2 and KP3, were both red. But we were also be giving a black accumulation signal here, and at the same time we were given a divergence accumulation signal here. Now these are two distinct signals, and here's the reason why, and why this is a really interesting trade. The accumulation signal you're being given here by the divergence software is based on market orders. The divergence signal, which is painting the black box down here, is being given to you based upon limit orders. So in this case, even though we have dark red numbers here, the KP2 was a negative 1778, the KP3 was a negative 1860. Well, basically what was happening is those market order sellers were being absorbed by a very large lot trader who ended up taking price 4 points higher. And that's why we have to be careful, and we have to look at the entire circumstances and not just look at the color red down here. In this case, we're looking at two things. We're looking at the accumulation of limit orders and the accumulation on market orders. So something that was real important to point out. Now here we have a great looking short trade where we have the divergence, and the reason that it's great is that we were being given special divergence. And special divergence is what is causing this red classification. So that is in and of itself an excellent trade to be looking at. Same way with the trade over here that ends up going for something like 8 points. We could see that we had a special divergence pattern, and the cumulative delta, the KP3 number, the high to the high, when we got that was a negative 1152. And then that took us into a strong trend trade, good for another 6 points, into another strong trend trade, good for another 6.5 points, into another strong trend trade. And you see the value of this classification system. What we're not doing is we're not taking these long trades here, this exhaustion trade here, and we're not taking this exhaustion trade here. Instead, we're going to take this next short strong trend trade, and that one was good for 7 points. Now, where does this end? Well, let the classification system tell you where it's going to end. All the way down, we are concerned about having the black classifications as this is coming down because they are accumulating them. However, the only one that would give us pause for concern is this one right here, where now the large lot traders have gone and they are now positive by 559 contracts from the low on the test of the low. Now the chart on the right here, that is the all contracts chart, and you can see that we did not get a green classification here either. So again, you're looking at another trade where the 25 or more filter gave you the correct classification. Again, and I can't stress this enough, is that you should be doing your own testing and determining what settings it is that you want to see, and not just the settings that I am suggesting. The settings that I am presenting in this video are my opinions only, and they don't represent any trading advice, and you need to go and do your own homework and not just be blindly following what I am doing here. Now we can see some of the same things occurring in real time, whereas here, after we had a successful accumulation trade, we traded into a trend trade pattern, and the black distribution marker from before is what eventually ends up turning this market and resulting in a 6-point short trade. Now, what is also very common and very interesting is, again, when we see these accumulations that occur both here and here, and we're seeing these both as dark red. Well, what is that? What does that mean? And why are these good trades? Well, what we're seeing here, we have a pattern including order flow to give us this 4.5 point trade. And here we have the accumulation to give us this 5 point trade. What we'd be looking for here is we would be looking for order flow on the entry here to get us into this trade. But the point is that each one of these trades is showing us that we had a market order accumulation, which is giving us the divergence accumulation signal on each of these. And then here we had a very strong ratio of a negative 177. And here this ratio was a negative 91, just a couple of contracts from what we were looking for at a negative 95. Well, why were they so good? Well, what you're seeing is that a lot of contracts had to get reversed because these sellers were on the wrong side on each of these trades. So this is why this trade goes for 4.5 points, and this is why this trade goes for 5.25 points. Basically, people are getting stopped out on those reversals. And then the people that stayed long, well, they're getting taken out in this 6-point sell-off right here. Now, the last really obvious pattern occurs approximately 3 hours ago. And in that pattern, what we see is we have created a strong trend, and then we had created a short exhaustion pattern here. Now, the way we're going to read this is we don't want to try and call any high. That is ridiculous, and the software is actually going to be telling you that once we are in a strong trend pattern, we don't want to be taking any short trades here. The 261, which is an extremely high number, is only telling us that we are going to see some kind of reversal because they are, in this case, almost 3 times more heavily weighted to the short side on limit orders than we normally see. But we're not going to try to call a high here. What we're going to do is we're going to wait for that test of a high, which is going to occur over here. And we again see that we had a 167 occurring here. Now, what is very important to understand about this is when we have a strong trend trade, it's going to be very common that we see an opposite black accumulation that we see down here. And this trade is no different. We see that here we have this black accumulation marker, and we had a very high value of negative 237. The point is that this is not at all uncommon, and the reason we are receiving these mixed red and green here is the green is coming from the cumulative delta low to the low, and that's to be expected because of how strong the strong trend in fact was. Now, here's the reason why we want to be seeing these numbers, and we want to take notice when this red comes up. The KP2, which is the high to the low, is a negative 3,323 contracts. In other words, there was some very serious selling coming in. Now remember, in order to get a red trigger warning, I put the value at 1,200. So we have almost 3 times the amount of contracts, and in real time we would be seeing this red marker there. And what that's going to do, what you should be doing is then looking up to see just how hard they are selling us. And for only 14 ticks or 3.5 points, that is a lot of contracts right there. And what do? They give one last chance to the buyers to get sucked in. They receive better prices up here, and then they sell. So what is the description of why we have black, red, and green here? Well, the black is obvious because what we're doing is we're distributing on limit orders. Now, the red is because of the high to the high cumulative delta value, the KP3. Now, what was also happening is there were a lot of contracts being bought because these are the buyers that didn't have enough courage to get in as the market was coming up here in this phase here. These people finally got the courage to pull the trigger here, and there was a lot of them, and they got their market orders absorbed, giving us this 167. So that's why we have a green here, and why I'm going to ignore this green in favor of taking a short trade here. Now, pretty much the ultimate signal that we would like to see is what's being set up here. And that is, as we go into this trend trade here, we had red classifications going into it. And then we see that we had a divergence distribution signal. And then at the same time, we have the trend trade pattern and the order flow pattern. But at the same time, what is happening is we are getting this black distribution from the limit orders. So this would be ultimate, that if you were able to get a black marker to go along with a known pattern and order flow, as is what is happening here. The other pattern that is extremely common and that you should look out for is when we have the trade here and we look back to the previous high and we have the distribution. So this is a trade where we are going to be looking to take, and again, the same reason that we talked about before, the black distribution marker here is setting up this pattern of a reversal trade here. And then that trade is good for 3 3/4 points. Now let's talk about some things that aren't as clear. So as we look at this first trend trade right here, we can see that we do have at least one green marker here, but we didn't have anything from back here. Now that in and of itself is not the greatest worry in the world, but it is not what I would consider optimal. And the same thing happens back here. Here the cumulative delta had only increased by 196 contracts from this point here to this point here. And while it did increase by 556 to here, that's really not a lot of contracts when you think about it. The market is pretty much going sideways. Now, these are a couple examples of what is less than optimal. Both of them worked, but that is what we are looking at if you want to take a less than optimal trade. Was everything positive? Yes. Here we had 719 contracts. Here we had positive 114. Here we had positive 556. Here we had a positive 196. So can it be justified because they were constantly buying throughout this 10-minute period? Yes. However, it is not significant enough to say that this would be a perfect trade setup. Here's a great example of why we want to give the due respect to the accumulation black marker. We can see that we had a very strong sell-off both in the KP2 and the KP3 numbers, giving us this strong trend trade with order flow and the bloodhound signal. But what was really happening is that buyers were accumulating on limit orders, and then they simply took them higher after we got our order flow signal. So again, very important that we look at where the black markers fall. One of the things you can also do with this indicator and classification system is put it on a big picture like I'm doing here. Here I've gone and created a 2500 tick chart, and I have made the appropriate adjustments to the indicator. I've set the KP3 value to 1500 and I've set the KP2 value to 3000. Now, what is important to me when I'm looking at something like this is I'm looking for the KP2 ratios, because what they normally end up doing is giving us the highs and lows for the day. So as we can see here on the open, we created an initial black, but we traded down into a strong trend, and we had a green classification here because we had over 9,500 contracts on the KP3. Now that gave us a trade of over 15 points to the eventual high of the day, and that eventual high of the day had the KP2 ratio of 222. On that sell-off, again, we're never going to try to call the high of the day. On that sell-off, we see that we received a red marker along with the aforementioned expectation that we're probably going to get a accumulation black marker here. But then what did we do? We traded up into a broken reversal pattern, which is right here, with a red classification because of the negative 5,500 contracts that we had right here. And that took us into a trade of 95 ticks, which is well over 20 points. So that's kind of what we're looking for. Now, on the sell-off, the number ended up to be a negative 93, which is only 2 contracts from what we were looking for. And when price came up later in the day to test this, we see that we had one more black indication here at a price of around 29.92 and a quarter, and we made basically a triple top after that, and then sold off on the close another 30 points. The following day was kind of unusual because it was a very tight trading day, but again, we see the same thing. We see that as price came up here and basically made a quadruple top, the first high where we had a 107 held, it was tested and we got a 117, and those were our 2 attempts at a high for the day. When we came down here and made the low, we created a 118 for the KP2 ratio. That came down and got tested pretty much to the tick right here, and as it came down and got tested on the tick right here of a 102, we see that the market bounced. So this is something that can be used on many different charts, and like I said, I like to use this as, I don't keep this chart in front of me, I keep it on a monitor that is right above my trading chart. And basically what I am looking for is, if I was looking to short this, as I said, I wouldn't be shorting it based on this right here, but I would be looking to a smaller chart to give me the justification to short that on the smaller chart, and then looking to see what happens down here as price falls. As you see right here, price fell into intermediate support. It was again telling us that we were getting a green classification and more than enough opportunity to get out of that trade. From that point there, from the apex, this is at least a 5-point move. So if you were in it, you had basically already made a very good profit out of that. I'm going to thank you for watching, and again, if you should have any questions, please give me a call. My next video I'm creating a video specifically on the trend trade, and what I'm looking at is I'm looking at how we go about classifying these things, and to give you sort of a little preview, here that is. So what I've done is I've gone and I've started doing an Excel worksheet, and I'm only marking the times where we lose as far as the date and time, so I can come back and look at those, because it's the losses that I want to study. But the losses are falling into a very specific pattern where we see that we don't have our KP2 or KP3 ratios going for us. In this case right here, this first loss, we had the KP2 and KP3 going against us. So these are kind of things I want to see, and it again is turning out to be very interesting. Here we had a loss where nothing was going for us. Here again, another loss where we only had the KP3 going for us. So basically what we're trying to do is we're trying to understand what the circumstances are that are going to lead us up to a losing trade. And if we can understand when to stay away from a losing trade, then our winning trades are going to be working all that much better. So thank you for watching, and have a good day. Let me know if you have any questions. Thanks. Bye.